Recent interview with Luke Gromen. You guys are going to love this video. Step number one, why is it when the Fed's BS or balance sheet increases, rates on the 10-year tend to go up? Editor, throw up that chart. We've used this chart several times, so I'll explain it quickly. Going back to 2008, when the Fed started quantitative easing, in other words, expanding their balance sheet, interest rates on the 10-year have had the tendency to move up, not down, which is counterintuitive because the whole purpose of quantitative easing is to bring rates down by creating more demand for treasuries. I've had hundreds of people ask me why rates have the tendency to go up when the Fed expands their balance sheet. Two reasons. Number one, it's a rotation from bonds into the stock market because investors know that there's a Fed put, and when they expand their balance sheet, typically the stock market goes up. Number two, which is far more important, I'd say this is 95% of the reason, is inflation expectations. The last thing that you want to hold if you think inflation is going higher is a 10-year treasury or a 30-year treasury. So when investors see the Fed expanding their balance sheet, they get really worried about inflation and they sell treasuries. I really want you to remember this, so much so that I wrote remember right here. I underlined it 3 times and put an exclamation right at the end. This is because at the end of this video, it's important that you remember inflation expectations are the reason those rates have risen, because I'm going to use this to put all the pieces of the puzzle together. Step number 2, let's go right to my interview with Luke Gromen and find out why he thinks money printing is set to explode.
Ultimately, no one's more short dollars than the United States government, number one, anywhere. And number two, the United States government has a printing press. And number three, there are very few governments in history that have gone without currency for lack of printing a fiat currency. You know, I think where that goes ultimately is you know, Bernanke talked about this in his '02 deflation speech, what they did in World War II, which was, you know, they set the short end of the curve at 3/8%, and they bought as much as 90% of short-term issuance, and they set the middle of the curve at 7/8%, and then they set the long end at 2.5%, and they grew their balance sheet whatever they needed to do to keep those, you know, the prices of the bonds there, and there is nothing that stops them from doing that. When they create currency, they create an asset and a liability at the same time. And so their balance sheet is theoretically infinite. So they can absolutely do that. And that's what I think sort of the end game is, if you will, of them basically, you know, we refer to as a Frankenstein yield curve. You know, you go 3/8, 7/8, 2.5 from, you know, call it 3 months to 10 years. And, you know, it'll be positively sloping. You know, the banks will be able to make some money with that positively sloping curve. But boy, it's going to be, you know, the balance sheet may be growing really, really rapidly, and that lends into some other potential second and third derivative impacts in terms of banks lending, you know, spreads, because if they're doing that, in theory, spreads will be blowing out, if for no other reason than inflation. So now are they going to get involved in agencies? Are they going to get involved in the corporate market? And it's a very slippery slope that they're now sliding down already, right? It's not like they haven't stepped off. They've stepped off.
Step number 3, is there a limit to the amount of money the Fed will have to print? Luke says that the United States is short on dollars. Let me explain what he means by using a very simplistic example. Let's assume that this is the amount of dollars in the system and this is the amount of debt. As the deficits increase, and that can be due to past deficit spending just compounding on itself, or new debt, like right now we have trillion-dollar deficits. This box represents that older debt. This box represents brand new debt. More on that in a moment. But Luke's point is that the federal government has to roll this debt over, and therefore short-term interest rates are incredibly important. How that works is the federal government's debt is broken down into a pie chart. Let's assume for a moment that that pie chart consisted of 1-year debt, 10-year debt, and 30-year debt. The average maturity on this pie chart would be much higher than a pie chart that included 3-month debt, 6-month debt, and 1-year debt. With this pie chart, they're only going to have to roll that over maybe once every 10 years. With this pie chart, they'll have to roll it over at least once a year. So what does it mean when the government rolls debt over? If this is our wonderful government right here, and of course, this is insolvent Sam, who could be your uncle. We've got Peter and we've got Paul. The government robs Peter to pay Paul. And how does it do this? It's got all this debt that is coming due that it owes Paul. So it just borrows from Peter to pay Paul, but the amount of debt that it has doesn't change. This is what Luke is talking about when he says the government has to roll over its debt. The key point here is that when the government has to roll that debt over, it has to have Peters that are willing to give it money at a very low rate of interest. And right now, the government is having to roll over within the next 12 months between $7 trillion and $11 trillion, pending on how you do the calculations. Since there is a huge discrepancy between the amount of debt in the system and the amount of available dollars, in a free market, only one thing could happen. Rates would have to rise to attract more dollars. And obviously, this is the world. And if rates rise, dollars will come flooding in from all over the world to fill that gap. The only other thing that could happen is the government would have to decrease their spending. So this amount of debt would decrease to where there was more of an equilibrium with the amount of dollars in the system. But of course, that won't happen because that makes insolvent Sam, who could be your uncle, extremely, extremely mad. That leaves us with rates rising or government spending decreasing. But I want to remind everyone that we are very long overdue for a recession. And in a recession, the deficits of the government always go up and go up a lot. Editor, let's throw up that chart. Going back to 1950, the average increase in the size of the national deficit as a percentage of GDP increases by an average of right around 4%. You'll notice since 1980, and especially since 1990, because the amount of debt in our economy has grown exponentially, the deficit every time we have a recession has gotten worse and worse and worse. In the last recession, the deficit went from 1% of GDP all the way up to 10% of GDP. And one last thing that I'd like to point out is if you look at our deficit now, it's at 4.6% of GDP, which has never been seen at any other time unless we're in a recession. So it's not unreasonable to assume that in the next recession, the deficit could get up to 15% of GDP or higher. So it's obvious that government spending is going nowhere but up, and that's only going to increase the imbalance between the amount of debt and dollars in the system. And you may be saying to yourself, well, George, okay, well, why don't we just let rates rise? That doesn't seem like too big of a deal. To hear what would happen if rates rise, let's go right back to my interview with Luke Gromen.
The reality is the marginal bid for treasuries would have priced out treasuries at 10 or 11% yields. So treasuries would have collapsed, mortgages would have collapsed, the equity market would have collapsed, housing would have collapsed, banks would have collapsed. They didn't have the choice. So it really is credit easing for the U.S. government.
So a catastrophic collapse of the entire world economy. Alrighty then. That takes us to the Frankenstein yield curve that Luke was talking about. The Fed pulls this off by setting interest rates artificially low across the entire curve and doing whatever it takes, and that means printing as much money as it takes to keep the interest rates at those levels. This takes us to the next question, which is how much money would they have to print? Well, in order to keep the long rates down, they do quantitative easing, and that would take the Fed balance sheet up to, let's say, right about here. But let's not forget about the short end of the curve. They've got to manage that through massive amounts of money printing in the repo market. So now we've got the repo market combined with quantitative easing. That takes us up another notch. But there's one more level. I call it the Buzz Lightyear level because that is when the Fed's balance sheet goes to infinity and beyond. That revolves around Peter. In other words, the buyers of the government debt when they're trying to roll it over or when they issue new debt in the form of brand new deficit spending. There's a few things that go into that. If this is the entire market of Peters, we go back to step one and we understand that when the Fed's balance sheet expands, some of these Peters go away because they take their money and put it into the stock market because they know there's a Fed put. We lose a couple more Peters because the Fed has Frankensteined that yield curve. And why is that? And this is something you'll never hear anyone talking about, because a lot of the Peters in the market are buying treasuries as though they're stocks, meaning they're gambling on the fact that the price will go up. They're not buying them for yield. They're buying them for capital appreciation. Well, if the Fed locks in the yield curve, that's going to eliminate a lot or all of those Peters that were exclusively buying treasuries for capital appreciation. And you may say, well, George, well, that doesn't make any sense because the Fed would allow the curve to go down. They just don't want rates to go higher than that. Well, not necessarily, because they can't have a flat or inverted yield curve for very long because then all the banks will go bust. So that leaves us with 4 more Peters. And the only reason these Peters stay or go is due to inflation expectations. Again, exactly what we talked about in step number 1. So we know the Buzz Lightyear balance sheet revolves around inflation expectations. And on that note, I have got some great news. Editor, throw up the chart. The Bank of Japan started to Frankenstein their yield curve right around 2016, and their balance sheet went from, let's say, 75% of GDP all the way up to 100% of GDP. Truly staggering numbers. So the Bank of Japan's balance sheet went from 75% to 100%, and inflation expectations remained relatively low. That is great news for the Fed, our Frankenstein yield curve, and the government, because that means there's most likely going to be more Peters in the market buying up those treasuries. And the more Peters there are buying those treasuries, the less amount of money the Fed has to print in order to make up that difference. It sounds like this video is going to have a happy ending. Not so fast. Editor, throw up a chart of inflation during World War II. The reason I pull up this chart is because the U.S. has done a Frankenstein yield curve before. That's right. During World War II, they did it to keep interest rates low. They did this from 1941 all the way to 1951. And what did the inflation rate get up to at its high during that time frame? 14%. And I'd like to point out that that is higher than the highest inflation rate we had in the 1970s. And what will determine if the Fed buzz light years their balance sheet, which will most likely collapse the dollar, will be if Peter, in other words, the marketplace, sees the future Frankenstein yield curve of the United States more like Japan or more like World War II. I'll let you be the judge of which is most probable. Let me know what you think in the comments below. To see my entire interview with Luke Gromen, make sure you check out that video. We'll upload it tomorrow morning. And if we've already uploaded it, we will put that right here. And for more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.